All attendees are in listen-only mode.
Good day, everyone. It's Dr. K coming at you along with Gil Morales. We have a market that has pulled back fairly sharply over the last few days. The S&P is right at its 50-day moving average. The NASDAQ is hovering above after having a nice little mini gap down yesterday. And we have a lot of leaders that have done about faces in the market. Not a good sign. Plus, we have this Hindenburg omen, which you can just Google Hindenburg omen if you want to know all about it. There's a good Wikipedia article that's fairly comprehensive on the phenomenon, and that's issued a number of sell signals over the last few weeks. So essentially, we've got a fairly bearish outlook right now. The market direction model is still in cash because, as we know, quantitative easing is still pumping in the system. So we've got the possibility of the market finding its footing at this level and then moving higher in that stair step little micro step fashion that it does at times. And certainly the last 5 weeks, the market hasn't gone anywhere. It's been flatlining, and then finally in the last 2 days it just kind of gave it up. So the model is closer to switching to a sell, and that could happen if we see a weak rally on the part of indices and leading stocks, or it could also happen if selling pressure were to increase and the S&P, say, were to break definitively through its 50-day moving average on increased selling pressure. Gil?
Yeah, I mean, I think we can all understand what happened to the market this week because Gil went into surgery here, and the market cracked here. And so the market always does something big when I'm not around to trade it 100% in full force. And so, of course, the market's going to gap down and break down on a day that was actually a big day for me coming back from the hospital on Wednesday. And then Thursday I'm still recovering and getting up later than I might usually simply because my body's undergone a great deal of stress. And, of course, anybody who's had surgery knows that if you think you're going to bounce right back at full energy levels, it's not going to happen. And so, of course, since I'm in that state, the market is going to break down and start to get ugly. And that actually started on Wednesday. The market looked a little bit funky to me on Wednesday, given that you were starting to see some of these stocks lose momentum. And some of the hot leaders, like LinkedIn and Tesla, LinkedIn on Wednesday had started to break down. If you look at a daily chart of LinkedIn here, you had on Monday, it's gone sideways 5 days, and then, of course, based on the 6-day rule, it needs to get moving, and so it does. It's like it responded to that rule and decided, okay, well, I'm going to get going here and start going higher. So it got above the 240 level, actually went above 242 up to 244 on an intraday basis, and then it starts breaking down on Wednesday. That didn't look right to me, and I saw that happening along with Tesla. It seemed like we're sort of in this phase where a lot of the viable gap-ups have lost their afterburn capability. So in other words, if you go back and look at LinkedIn back in January when it had its viable gap-up, that had a lot of afterburn. In other words, what I refer to as afterburn is this continued upside that occurs after the viable gap-up, and the stock just continues higher. It has a lot of upside thrust following the viable gap-up. You can see the same thing with Tesla back in May. You had a lot of afterburn following this viable gap up, and that was a beautiful move. I played that pretty well and got the majority of that move on the upside, and that was a very quick 2-3 week move that was very profitable. Whereas now you get 150% above the 200-day moving average, just way, way down here on the chart, and you get this viable gap up, and it loses its thrust, and there's no real afterburn. So it's telling you that even the strongest leaders, when they're having these viable gap ups, are not really getting going, and they're not showing much of this follow-through to the upside. But in a way, that sort of makes sense when you consider where the market is and where the indexes have come from all year long. It's been a very choppy environment all year, and a very difficult environment for those who utilize pyramiding techniques, because stocks will tiptoe their way higher and then come crashing down and then stop you out either a part of your position or all of your position, and then turn around and tiptoe their way back up. And the market's been that way as well. So, I think in general, what you're looking at here, it's a very tough situation. The NASDAQ was looking like it might be forming a little base here on top of a little base here, and now it's broken below the top of this level here, which I think now becomes sort of level of resistance between here and the lows here of I think that's last week, around 36, 33 on the NASDAQ. So, you know, this is starting to break down. You get a big volume gap down move off the peak. That's usually not a good sign, but it's also not necessarily indicative that you're going to have this massive breakdown immediately. Markets will take time to top. I even went back and looked at one of the worst tops in March of 2000 when the NASDAQ came down very hard. That took a couple of weeks for the market to zigzag around before it really started to break down hard. For any of you who want to go back and look at that daily chart of the NASDAQ from March of 2000. So it's going to take a little while. And in the meantime, you'll see some stocks breaking down, but some stocks will be holding up. And there is a little bit of that going on right now. I think first I want to look at gold and silver. First of all, silver, you know, last week it struck me that there was talk of tapering ending in September, that the Fed would move to put out something more definitive in terms of what they're going to do with respect to tapering. And it seemed like, you know, stocks sort of shrugged it off, didn't break down. They were kind of going sideways. You know, the index is going sideways the last week until yesterday. But we saw, you know, silver starting to move last week, as well as gold. And gold was up last week and got above its 50-day moving average on Monday. Not enough volume on Monday to trigger a pocket pivot, but what you do have here yesterday is a pocket pivot on a range breakout. If you consider this from here to be a range, it's popping up and out of this range. You might also notice here's a 65-day exponential moving average is popping above that. That's a moving average that I use because it's used a lot by commodity traders that I know. So that's one of the reasons I've used it, and you know, at times I try to apply it to stocks. It seems to work better for commodities. But in any case, you could consider it working here on a sort of a 65-day exponential pocket pivot on the GLD, on gold, and so that's moving higher. And I believe we're up another $6 on the nearest futures contract at 1366.90. So my son has a real fun time with this because he likes to keep track of our gold holdings and where they're trading. So whenever gold is rallying, he seems to be in a good mood. But it has been moving, and it looks like it's starting to try and turn. But this seems to argue for continued QE. On the other hand, the action of stocks seems to be arguing for some sort of tapering, especially the gap down yesterday. Dr. K, was there any specific reason why the market gapped down yesterday?
In terms of, really, it was the leaders.
News catalyst?
Walmart and Cisco getting hit very hard, gapping down, and Cisco being a fairly significant part of the NASDAQ. When that gapped down, other tech stocks also got hit in tandem. So that's really responsible for the reason why the NASDAQ gapped down as much as it did, whereas the S&P was off less.
You know, I have to say that I have a hard time believing that a stock like Cisco Systems, you know, maybe back in the 1990s when Cisco was really one of the mainstays of the market, maybe that would have given the market an excuse to sell off, you know, much like Apple used to do in the mid-2000s whenever it had a bad earnings announcement. I think there was one in like 2011 or 2010 when it got hit and the market came down with it. But Cisco, I guess, being a big part of the NASDAQ index brought it down, but it seems like you know, why would the market really care? Because Cisco is sort of.
I think the market's looking for an excuse to sell off.
Yeah, that seems to be the case.
Look for anything.
Right, and it'll
not,
latch
you know,
on
in a
anything.
strong market, I don't think a market would really care. It would shrug off the Cisco News, their earnings report. But right now, I think the market's been forming a possible, you know, major topping formation. You know, we won't know till we see further evidence. But the market's been very weak in the face of quantitative easing. I mean, with the S&P 500 pretty much tracking sideways for the last 5 weeks.
Yeah, and so I kind of like, we talked about that, I believe, on Wednesday morning, or when did we have the gap down? Yesterday morning. And we talked about the fact that, you know, we didn't think Cisco's not really the cause of all this. The market's looking for an excuse to sell off, and Walmart as well got whacked. pretty good. And you know, is this a big leader that's been driving the market higher? To some extent, yes, but more recently not. So, you know, I don't think it's the be-all, end-all of the market's health, but I think it does tell you that the market's looking for an excuse to sell off, and so it will grasp onto some sort of news, and that becomes the alibi, so to speak, for the sell-off. And the alibi can also be used in reverse, because if the sell-off is allegedly based on some news, and then suddenly 2 days later there's some improvement in that news, and that becomes an alibi for a bounce, and institutional money will use that alibi for a rally as an opportunity to unload. But does it look to you, Dr. K, as if the institutional money has been distributing stocks in general?
Yeah, it seems like on the rallies there is institutional money coming in and doing some selling. So it seems like there is some mistrust going on that this rally is going to persist. And you know, maybe it could also be, you know, institutions just are looking for ways to lighten their exposure because they're fairly uncertain about the environment. The market likes to look forward, so because of that, the market is perhaps telegraphing to us that the economy is going to turn around and the Fed is going to start tapering quantitative easing maybe as soon as September.
But apparently the economy won't be turning around enough to drive huge growth. It's still pretty tepid. It almost seems like the Fed...
The Fed also is very concerned about tapering too soon. They don't want to do anything to derail a fragilely recovering economy. So my guess would be that they don't taper in September, but they are going to taper at some point. And markets tend to look 6 months out. So in other words, they might be telegraphing to us, look, the tapering is going to start in January of 2014, and that could be the reason for the markets putting in a major top here.
Yeah. But why then are the metals rallying, which is really the gist of what I'm trying to talk about here?
Yeah, I think we got a pocket pivot. You know, and we got silver and gold.
That's a big move. That's a pretty big move in silver here. You know, yesterday and also in the GLD. I think those are pretty sharp moves to the upside.
Yeah, on the weekly, it looks pretty pronounced, and it looks also kind of constructive in that they've both put in lows. And you know, it could be a combination of a fear factor at play. It could more likely be the reports, the economic reports out of China and Europe that show that both regions are potentially turning up economically, and therefore will exert greater demand on precious metals like gold and silver.
I guess over the coming days we'll get a better handle on where the buying has been coming out of. But one thing that occurred to me is that stocks and I think bonds actually got hit pretty good the other day. Let's take a look at the TLT. Bonds have been getting hit, and they're down again, making new lows on the 20-year plus Treasury bond ETF, the TLT. And so my thinking here is that if China is looking a little bit better and they're liquefying a little bit, because they did intimate that they would be, then maybe what's happening is a little more rigorous or vigorous conversion of dollar-denominated assets into hard assets like silver and gold. And so you're seeing them come in and buying up, you know, in other words, the Asians are in here buying up the gold and silver as they're seeking to diversify away from dollar-denominated assets, because they do stand to take a big hit if if the Treasury market starts to get hit and the Fed is not there to prop it up anymore. So it would seem to me that could be one countervailing force here that's driving the precious metals higher. What do you think of that?
Yeah, and I think that's an absolutely viable argument because we know that the Chinese have been unwinding their huge position in U.S. Treasuries for a long time now. It's in their interest because they don't see the U.S. as the world's leading economic power. Say 10 years from now, they see themselves, and I think that's
right.
That's a probable event. So it's smart for them to unwind their treasuries and buy precious metals, buy gold, and that could as China recovers economically, that could be a formidable force in terms of boosting the price of gold and reducing the price of treasuries.
I'm going to go through some questions here real quick, just so I can move down the list so I don't get too far behind. thoughts on InventSense. We talked about this last week. The stock maybe needs to go sideways. The movement up this week has been caused by talk of Apple, I believe, on Sunday is going to announce a new iPhone, I think a cheaper iPhone, and they may, whenever that happens, they're going to be trading on news that maybe they're going to get a design win there. That's a possibility, but if it doesn't happen, the stock may just drop in. I have a problem with this stock. I think it's holding in okay. I guess if you want to own the stock, you could, but I'm not really expecting any big upset. I think if there is to see that broaden significantly over the coming months in order to drive a big move in the stock. So that's really my view on the stock. And I think, Dr. K, you mentioned last week that the stock probably needs to continue to work sideways and will probably do so for a period of time. Is that your take now?
Yeah, I mean, it's InventSense has formed a very big basing pattern that is not quite tight or constructive yet. It's pretty wide and loose, and so it's going to need to do a little bit more work. Once it gets tight, though, I mean, sometimes all it takes is a couple weeks, a few weeks of really constructive action, and that could work as a viable launch pad. And we would probably see that in the form of a pocket pivot buy point.
Okay, someone wants to know about the 6-day rule. I was thinking we should look at LinkedIn on the 6-day rule because you did mention that in this morning's pre-market pulse. So you had 1, 2, 3, 4, 5 on the 6th day. It moved higher, and then now that it's 6, 7, 8 on the 9th day, it broke the low, the intraday low here. So you consider it a sell at that point. Is that correct?
That's right.
So what is the general rule, if you could review that for everybody?
After the gap up day, if on the 6th day or later it breaks below the low of the gap up day, you sell it. You don't give it any porosity.
Okay.
Now,
so
prior to the 6th day, you give it porosity in context with the pattern, which typically tends to be 1 to 2%. But sometimes it can be more if the stock's particularly volatile.
I don't know. I thought the problem with LinkedIn for me from the start, is that it didn't get going right away. I thought it should have had more afterburn. So, which and really net, it hasn't really gone anywhere either way. So it's trying to hang out now. Now, is there a situation where it would become viable once again?
Sure. I mean, if it sets up again, I mean, you could certainly set up in here and then issue a pocket pivot, and that would be a viable entry point.
Okay, so that's basically what you're waiting for now. The Bible gap up is pretty much off. Notice how I did find support today at the 20-day moving average, which sometimes comes into play on stocks on pullbacks. I've noticed that looking at a lot of charts over the years.
It's also possible, let's say we had a pocket pivot today, that would be potentially viable as well, depending on how it looks near the close.
Right. Yeah, someone's making a good point, I think, on the gold and silver. Yesterday I noticed on the news that they were talking about Soros had sold all of his gold in the second quarter, and Paulson has sold all of his gold, and I think there were a couple other guys who had been long gold, and they had dumped it all, and so now that the pressure of these hot money hedge funds being out of the metals, that's also, there's no sellers left, in other words, to hold it down. So I think if you get any incremental buying, that seems to drive them higher. And I think it's true with those guys out of the way. If you have the Asians coming in and buying, then I think you're going to see these things turn and go higher. So I still think gold is going to be a lot higher eventually. I don't necessarily buy into the idea that it's topped and that you're going to see it just continually go down. I still think a lot of the issues about fiat currencies exist there. So somebody is asking, Dr. K, how can you tell that institutions are selling rallies intraday? Well, because you see, I'm just going to say that you see stocks moving up and then the rally gets sold into. I mean, most of the activity is institutional activity. It's not retail investors with their day trading accounts trading 100 share lots. Most activity in the markets is institutional. So when we speak of institutional, it's not like you can tell that it's institutional or retail, but we figure the odds are, given the magnitude of the institutional side of the market versus the retail side of the market, it's going to be institutions. I mean, most money that goes into the market from retail investors goes into mutual funds. A large part of it does. So that's institutional money, and then it's institutions that are wielding it. So, and in general, I think maybe it sounds more ominous when you say institutional selling, but institutional selling is generally systematic, and so you'll see it occurs over several days. You'll see the market rally, and then it gets sold into. Market rally, and then it gets sold in. So it's sort of a persistent pattern. And since institutional activity tends to be something that takes place over a course of several days or several weeks sometimes, then you're going to see a pattern develop. And so when you see that happen over and over again, that's usually what it is. Now, it's not like we have some detector that is going to tell you this is institutional selling, or don't worry, this is just your grandmother selling her 100 shares, which in most cases it probably isn't. But there's nothing really like that. But you can tell when it's a pattern like that, and when it occurs persistently. Dr. K?
Yeah, big volume footprints. That's what we're looking for,
Yeah.
because it's institutions that are swinging 10,000 share blocks, if not a lot more.
Let's see. I think there was also on the gold front we were talking about NUGT the other day in the chat room. Nugget, this is a daily gold miners bull. There's also the GDX, but these are also moving, and a lot of these guys. I even think that Jeff Vinnick, who shut down his fund, was long these miners for the last several months, and he got really hacked to death on this position. And so these guys are all out of them. They've all blown out of them, and they're getting now these things are just lifting. Somebody's asking about Oracle and IBM look like shortable patterns. Yeah, they could be. I mean, you got resistance here at the 200-day on Oracle, and it's starting to roll over again. This is what it looks like on the daily chart. Not a lot of volume. I guess if you're able to catch the rollover through the 200-day moving average, then you're probably able to catch some profit there. Maybe it is headed lower. They're trying to convert to cloud businesses, I suppose. IBM, same thing, but that was probably up higher, as it ran into the 50-day moving average here. But pretty ugly, choppy pattern. So you can even, say that, well, this looks shortable here, or it looks shortable here, or it looks shortable here. But each time it wasn't. Maybe now it's going to blow apart with the general market. That's a possibility, I suppose. But that's been looking ugly for a while. So down here at the lows, is that going to blow apart? I don't know. That's you can take a shot at it, I guess, if you know where your stop is. But it seems to me like the best spot to try and hit it would have been more recently at around you can see there's a 10-week moving average, or around the 50-day on the daily chart here, and that actually would have been this gap up on this day. Somebody's asking, is the 6-day rule in your book, or is it new? It's actually new. Dr. K, the inverse ETFs that you mentioned for the MDM signal, should we go to a sell signal or a thin volume? What is your reasoning?
I would say that again. What's my reasoning for the selection of ETFs on the latest sell signal?
There's someone saying.
I mean, basically EUM and weakness begets weakness, and EUM and EEV are inverse to the MSCI Emerging Markets Index. And if you'll note that if you type in EUM or EEV, you'll see that those are considerably weaker than, say, ETFs that cover well, I should say it this way. Emerging markets get hit the hardest when there's weakness, and so it's not a bad bet to go and buy the inverse, betting that those markets are going to go down the most when the market's weak. That means these markets are all correlated. So when the U.S. market's weak and falls by 5%, these emerging markets are going to fall probably by 10 or 15%, and you can see that in the pattern. If you just go ahead and pull up some emerging markets indices like the MSCI index, you'll see that it tends to have a lot more downside than, say, a European index, Western European index, or a UK index, or any of the indices in the U.S.
But that's not to say that one can also implement the MDM signal using the usual U.S.-based indices, right?
Yeah, I mean, our flagship really is the triple Qs, because they're good proxy for the NASDAQ Composite. The triple Qs mirror the NASDAQ 100. So if you want to stick to that results page, which is fairly stable, there's no reason not to do that. But we do think that the emerging markets are going to get hurt more than the U.S. markets, which incidentally the U.S. markets have been showing the most strength and resilience compared to any of the other world markets. So if you're going short something that's strong, you're probably going to perform less. On the other hand, you're going to probably get less volatility. Well, you definitely get less volatility in shorting the U.S. market, say the NASDAQ or the S&P, than going short an emerging markets index. So it comes down to trading personality and risk reward.
Somebody asking which one I think is the better short, Oracle or IBM. I don't know. I guess Oracle is a better position in its pattern. IBM is running along support, so maybe Oracle. But in terms of, looking for stocks to short that fit the models, I don't really know. This isn't really the perfect sort of head and shoulders type of setup that I'd be looking for. It might be, you might say that this is an ascending neckline and maybe it's rallied right into the neckline and maybe it becomes shortable on that basis here. So, maybe Oracle. But the thing is, these are not big hot leaders in the prior bull phase, so they don't really fit. Either one really, to me, fits the definition of a big hot leader that all the institutions pile into, and now they have to pile out so much as, say, Apple was last year. So, to me, neither one is all that exciting. Last week, we talked about First Solar being a short, and that's broken down. Now it's down at the 200-day moving average. I think something like a Solar City becomes shortable on rallies if you can borrow it. But that doesn't look too good to me. It looks like it wants to head lower. And it reminds me of SunPower from back in 2008, I believe it is, or was rather. Go back, if I can go back to that date. Let's see how long it takes me. Yeah, that was SunPower. I made this little cup with handle and it broke down. Took a little while to mess around the 50-day moving average, and it blew apart and came off. And so today you see Solar City forms just still a cup with handle. Now it's sort of coming off, and it broke down last week through the 50-day moving average. Those are kind of things I'm looking at because they were hot stocks, so pile in, pile out, basically. LVS, not a name I'm looking at. I don't know, is it a short? Probably not right now. Is it a long? I don't really see any basis for buying the stock. Dr. K, wouldn't buying pocket pivots be a much more risky proposition in the current market? Is one supposed to buy on a pocket without regard to market context?
Always take things in context in terms of your position size and whether you want to trade the stock at all. So if the market's in a downtrend, then you're generally better off just staying in cash or going short select positions. That said, there are the rare occurrences where a stock has great fundamentals and a great technical setup, and it's bucking the trend, the downtrend, and maybe that's the kind of stock that you might want to put half a position into. And then if it works, and you can always buy more. You'll get another buy point on the way up, and you can pyramid higher, pyramid up, which is always a good technique, with the reverse of that, pyramiding down, being sacrilege.
So let's just take an example here. So here's a pocket pivot in FLT. So if you bought it, my general view is if it can hold up tight along here. If I buy something, the market starts to look weak. Anything I bought right away, I'll just sell it and go away. Better to go away than to get caught in a downdraft that could take you down 5% or more in a hurry. So, but yeah, anything you buy, it has to be. It has to be within the context of the market. If the market's getting hit and you have a big volume gap down off the peak, I'm not going to buy anything, even if something is showing a pocket pivot, because the odds of it working are not that are not that great, and they diminish, the weaker the general market action is. So I think that you have to always take that into account. So, when we put out an alert, and we're not necessarily making a buy recommendation really at all. We're just pointing out the positive technical action, because let's say the market does correct and it goes into a short-term correction, and you begin to, you see this stock that's showing a couple of pocket pivots, and it shows a couple of more as the market corrects, and it's acting okay, then that stock could actually become viable once the market rights itself, and it would sort of highlight itself as being a stronger stock. So it's useful information, but you really cannot be an automaton thinking that anytime you put out a pocket pivot, oh, you're just going to go ahead and buy it without thinking about what you're doing. So we don't really intend for that to be sort of a mindless signal that you're just going to take and just go ahead and run with regardless of the environment. It's basically, the point is to give you some information about stocks that are acting strong in environments or on days when things aren't exactly that positive, or where you're seeing a lot of other stuff breaking down. So somebody asked a question, can you provide insight into how much time we should be spending pre- and post-market preparing each day? Well, I think you should spend 18.6 minutes pre-market and 32.875 minutes post-market. How's that? Does that work for you? That should solve all your problems. All joking aside, in general, what do you need? What do you think you need to look at every day? How much do you need to look at every day in order to be prepared? I find that I don't need much more than half an hour before the market, or more than a half hour to an hour after the market. I might spend a lot more time because that's all I do. But for somebody who doesn't have a lot of time, you really have to break it down into the essentials of what you need to know. So, you run through your list of stocks every day at the close, and you see what everything did. So if you have a buy list, you run through all your charts, and you cut out the ones that are acting well. You may add some new ones if there's some new stocks that are acting better, and they're starting to highlight themselves. So, that's really all you're doing. It's not really a function of how much time you're spending. It's a function of how much time you have to spend, and then getting your routine down to fit into that time period that you're able to make or set aside for doing your market analysis. So much of the market's starting to come off a little bit more. So you can see yesterday's gap down. You get a bounce today in a lot of stocks, and not really showing a lot of oomph coming back. Let's see here. Oh, somebody makes a good point. See, Dr. K, I was telling you, somebody says they can tell by my voice, somebody who's a doctor, that the anesthesia is still in your body. Yeah, I would agree with you on that. It can take a while. It can take a while to wear off, and I actually can hear it in my voice as well, and also just in the way I feel in general. It's like I said, like I was telling you guys earlier, I noticed that. Oh, God, here's another question. I'm not sure where this person got this from. But anyways, a doctor is recognizing that in my voice he can hear the fact that I still have some of the anesthesia in me. And, yeah, it was like a 2.5-hour procedure, so that's a fair bit of time under anesthesia that's going to stay in you. Now, the question is, does it go into your fat cells and stay there where it's going to have a longer effect? But they're basically telling me, give it a week to wear off, and then you'll be fine. So somebody, I guess, just completely missed my point about SunPower. You're just talking about market context and pocket pivots. In late 2007, the market was tanking, yet you were buying solar power stocks despite the poor overall context. What factors led you to dive in when that? That's not what I was talking about. I was talking about how Solar City, this is Solar City today, cup with the handle, it's breaking down. That's a short, okay? And I pointed this out last week that I thought this stock is a short on the basis of being a late-stage failed base. Then I went and I looked at SunPower back in 2008, not 2007, and I never said that I was buying solar power stocks back then in the face of a market correction. What I'm pointing out is how Solar City looks like here's SunPower back in 2008, okay, and it broke down actually late 2007. It had a cup with handle, and then it broke down. So I'm using SunPower from 2008, basically late 2007, early 2008, as an example or a precedent for SolarCity today. So I wouldn't say anything about buying it. This was a short sale, and it's a late-stage failed base in a stock that was very much a hot stock at the time. And much like SolarCity today is, and I want you to look at that. You see that prior SunPower pattern. Now look at SolarCity. It's starting to break down. It looks very similar to SunPower back when it started to break down back in early 2008. So I wasn't making any point about buying solar stocks in 2007. So anyways, be careful what you think you hear. Should we sell truly on today's rally? It's acting okay. This is one stock I noticed it's actually holding up. So, you look at it on the weekly chart. I guess you could, based on the fact that it's a squirrely stock, but the stock is actually at a new high, new closing high right now. So I think that in general, it's holding up. You could use a 10-day moving average maybe as your selling guide. It hasn't violated that. But, you could also sell into the move because of the general market environment. So I missed the first part of the webinar. Did you comment on the divergence in the advanced decline line? Well, we talked about that last week. So really, that was kind of a clue last week, and so I don't really see any reason to go into it now. The NASDAQ advanced decline line is pretty useful, or useless rather, because it's always making new lows, because it's just continually declined since they started, I think, back in 1973, mainly because of all the stocks in the NASDAQ index that either go out of business or tank, or because there's a lot of small cap stuff in there. So I think in general what happens is the NASDAQ advanced decline doesn't really represent the meat of the market in terms of institutional quality stocks. You get a lot of small caps in there and fly-by-night names that eventually come apart. So the S&P or the NYSE advanced decline is a little more significant, and of course that's been rolling over. I showed you guys a chart of that last week, and that's been rolling over for a while. So the divergence was telling you that something wasn't quite right, and so I think you're seeing it in the action yesterday in terms of the big gap down, and so it actually was providing a clue. Now someone else says they think I sound fine and coherent. Someone else who's a doctor. See, the funny thing is we get a lot of doctors as members, and it's interesting because I have to tell you, when I was in the hospital, I had my laptop going on Tuesday, even though I'd been, not more than, say, I'm going to say 12, 16 hours out of surgery. I had my laptop going on Tuesday, and then I had my laptop going all day on Wednesday. And what I noticed is that this attracts doctors to your room, which is, I guess, a good thing because you get a lot of input on, what you're feeling and how you should be feeling, even though the doctors have nothing to do with your case. But you get people coming in, and even my own doctor, I think half of the time he spent consulting with me, we were talking about biotech stocks, which he's big on. And but it's interesting that you get you'll get a lot of doctors giving you their input, which I appreciate. I just want you guys to know that, all of you who have sent in emails and texts and messages and whatnot, offering to provide any guidance if I needed it or was uncertain about anything, and I do appreciate that. But it's interesting, some of the people say, like one fellow who's been very helpful, and usually the anesthesia is washed out quickly, and he says some can be stored in fat cells but should dissipate without issue. I think you sound fine and coherent. It's a bit more sedate and calm. Yeah, I am a bit more sedate and calm in general. So, it's kind of hard to be a wild man when you got a bunch of staples in your stomach. Somebody says maybe we should keep you on it. And 6 stocks, 7 different opinions. That's true. Somebody asked Dr. K, the U.S. press is talking up a story that the euro is out of recession. Is that really true?
Well, Europe seems to be turning the corner. The flagship country, Germany, came out with recent reports that favored the argument that they are indeed turning a corner economically. So if, where Germany goes, obviously that's representative of a large part of Europe in general. And if you look at, say, IEV, which is the iShares Europe ETF that mirrors a collection of European countries, you'll see that's been, in the last few weeks, that's been in an uptrend, whereas the S&P 500 has been in a sideways pattern. So for the first time in quite some time, Europe is actually pulling ahead, showing more strength than U.S. counterpart. Therefore, if these reports persist out of Germany and other European countries, then perhaps that's added evidence that Europe is maybe closer to seeing the light at the end of the tunnel as concerns their recession, which has been going on for quite some time now.
Does it matter to the U.S. market?
Yeah, because all these markets are linked, and the correlations vary, but there are still correlations between, say, U.S., Europe, U.K., and then those are the debtor countries, the main debtor countries, and they do have a fair amount of correlation throughout the years. And if you look at countries like China and India, Russia, big creditor countries, there's still not a high degree of correlation, but I suspect that in the coming years there will be greater and greater correlation, especially as China, their growth rate continues to be quite robust, and I guess they start to take, or slowly start to take the lead economically. But this is still, we're talking a good 5-10 years down the line.
Just going through my list this morning, I was noticing you got SSYS, Stratasys pulling back to the top of its base, so that's acting okay. I noticed Chipotle Mexican Grill, which has been trying to hold up after the Bible gap up, is still going sideways. So some stocks have not broken down yet. I would say some of these you can keep an eye on because they're not really breaking down. But if the market gets weaker, and you can see that that's happening right now, then the chances are that, in fact, you're going to see them start to come off more. And anything that's holding up in a weak market just becomes the next thing to come off. But I did notice these, the FleetCor is trying to hold up. Even Gigamon has been, yesterday made a new closing high. And that guy's trying to hold up. And I'm surprised because in a weak market, thin stocks like this usually get raked. But I think this may be getting more of an institutional following. I do think if it is going to have further upside, the market corrects, watch for it to go into a base. So I'm thinking that looks okay. Lionsgate Financial has acted like a champ for a long time, and it's continuing to hold up. Lumber Liquidators going sideways and holding the 10-day. So a lot of these stocks are holding up here. Not everything is breaking down. M&T Bank is holding sideways. In general, though, the XLF has not acted well, and it's been getting hit. But that's some of the bigger financial names like Goldman Sachs, Wells Fargo, which has been coming off, Citigroup, which has been coming off. So you've seen the banks coming off here. But I notice MTB is hanging a little bit better. But these are just things I'm noticing are not coming off hard with the market. Michael Kors, a lot of retailers have been getting hit the last couple of days. The Walmart thing, was one factor. But it's pulling back. It doesn't really follow its 10-day moving average. It doesn't even do that great of a job of holding its 50-day. But that after the breakout, it's running up and pulling back. It doesn't look abnormal just yet. NSM, these are pulled back, but they're bouncing today. This one and OCN, the mortgage servicers, and they're kind of hanging in there. So names just to keep an eye on here. As I'm going through them. Netflix had a little pocket pivot in here. I think it was this day right here. Is that right? Yeah, that would have been Monday, and it's holding that so far. I mean, nothing exciting, but stock had a broke out, ran up. Had a pullback to the top of the base roughly, and it's trying to hang in there. Not breaking down just yet. This NXPI, which we put out as a pocket pivot back in here, I believe, has run up and is holding up, and doesn't seem to be breaking down, so it's holding its breakout. Centaurus is another one that I noticed is pulled back. It's failed on its Bible gap up, but you might expect that after so many Bible gap ups in the pattern. And so now you're pulling back on top of this here. I don't know if this is going to hold. I think if the market gets into more trouble, it's going to come off. But it is trying to hold. So I don't think I would have gone hog wild on this Bible gap up given the fact that it had already had a number of other Bible gap ups, but it's trying to hang in there, so not really breaking apart. And I wrote down Truly as well from earlier because I was noticing it's acting pretty well right now. It seems to want to hang in there. Doesn't really want to break down. Valiant Pharmaceuticals, pulling off a little bit as the market weakens, but it was acting very strong before, and it's holding the 10-day. Acadia, I don't know, this one, I hate this stock too. It's a trader, it goes up one day and you sell into it, or maybe 2 days and you sell into it, but it's just kind of bopping sideways, trying to find support at the 50-day moving average, but not really going anywhere after announcing earnings. So it's kind of a disappointment there. It didn't do anything. A little bit on the feeble side. Some stocks that are trying to pull back to their 50-day moving average in addition to Acadia. You have Celgene, but this thing, Dr. K, what would you do here? I mean, this thing is runs up, and now here we come all the way back. It's probably at the 10-week moving average after this breakout. So I guess would you buy it here?
Yeah, it's an interesting one because it's going. If it goes below the gap up day, then you should sell it. And in this environment, that's probably what I would do. If you wanted to be a little more flexible, giving it a little more room, you could always wait to see what it does at the 50-day. It could bounce off there. If it bounces weekly, then you could sell into that week bounce. That's how I'd handle it.
Yeah, I mean, but I hate selling a stock right on top of its base breakup because of a lot of times stocks come back to the breakup point and rally. So they were just asking how you would handle Celgene. I think you gave a good answer there. Facebook, it has a run up, and like I told you guys, I thought it's going to go sideways for a while here, and that's what it's doing. Nothing really exciting there, but it's well above the Bible gap up. Had a nice move higher, and just hanging out. So it doesn't look terribly, bad here. The COG failed on the Bible gap up, but again, oil stocks, we don't really care for them. Q-Core is hanging in there, following its Bible gap up. Not a lot of movement here, along the peak. It's trying to hang in there, so there's nothing really negative one way or the other. So somebody's mentioning the RTH is breaking, falling apart. What retail stocks look best to short? Well, that assumes that there are stocks in the retail area that are setting up. All this has done is you had a breakout here, and the RTH has pulled back to the breakout. So the RTH in and of itself isn't showing necessarily a short sale setup. But where would you look around? I don't know. I was looking at let me take a look at some names. Lulu, maybe it's Lululemon breaking down through the 10-day, and holding right at the 200-day. So I don't know. This is that's the weekly chart on Lulu, so it's hard for me to say, is this a big, ugly head and shoulders, and you got a couple of left shoulders and one right shoulder, now it's going to break down. Maybe Lulu is one to look at. It's at the 200-day. Last week, I think I talked about Regeneron in the biotech area as being shortable if it broke down through the 50-day, and it did that on Monday, so that's continued lower. So that was one short sale target that would have worked. But, I think that in general, when you're looking at, say, an RTH breaking down, it doesn't necessarily imply that there are retail names in short sale setups. You might have some that are still doing the same thing. They're pulling back, like Coors is pulling back, but it's not breaking down, so that's not shortable. And I think you just have to look around. The one that I was looking at and maybe the weakest is Lululemon. Triple D, this stock has held up okay. There's a lot of tightness in here over the last several weeks, but it looked like it was going to get strong, and it's coming down with the market. It's probably the jury's kind of out here if you're going to buy it along the 50-day moving average. I don't think, however, that I would be buying any stocks right now. My view is whatever longs I had get tossed, and I'm going to hang out and wait and see how this thing develops. So the ARM short, this is still a live short as far as I'm concerned. You have the black cross here where the 50-day moving average moves below the 200-day moving average, and now it's just kind of hovering around up here along the 200-day. So, this may work. And here's the overall head and shoulders pattern. So it is showing, the resistance up here and reversal off the peak a couple of times. So you had this rally back up in here, and so, it may still be viable. I think 42 is probably, the highs here would be your stop if you were going to try and short it. So UA, it ran up, and it's coming down hard along. I think this is another one that's, the retail stocks are weak, so it's affected by that. And coming into the 20-day moving average is still holding the viable gap up. So, for my money, though, I'm out of it, took a profit in it, and that's that. So didn't really care much for the gap down off the top here. It looks kind of weak. I already went over SSYS, but I'll go over it again. You had a breakout here. You pulled back to the top of the base. You're still holding the breakout. So the only place to buy would have been the breakout, and it's still holding for now. So the builders, yesterday they were all, on the news. They were all over the builders as being, you get into the builders now. They're having a great move. It's a one-day wonder. So you come right up into resistance. They probably become shortable up in here. So probably this morning they were shortable. Not sure I'd want to get into them down here. I think if you can pick off the peak of the rally into resistance, you're probably good there. And that seemed like that could have worked. Let's see, any other questions? We're getting towards the end of the hour here. Nope, doesn't look like we have any more. Oh, here we go, data. I don't know, this is a thin stock. I don't really get involved with these kind of stocks, even though it had a big viable gap up here. Any take on this, Dr. K?
Well, it's undercut the low by enough that you should have been selling this one. It is a thin. Well, I would say it is relatively thin, and it's an IPO, and therefore it's going to have a lot more volatility. The earnings are really pathetic. So this has a lot of caveats if you're going to play this one, and I would be on the cautious side. So I would have sold this one already if I bought it, but it's really not my kind of stock in this kind of environment.
Yeah, it's too thin. That's my take. YY, I don't know. It depends on where you own it. It's trying to hang in there. Came down through the 10-day, but I don't think you're using that as your selling guide. So, I guess your ultimate selling guide would be the 50-day moving average down at around 34. Not much else besides that. Kihu getting a nice rebound today. So I don't know what you do there. I guess you could sit with it if you wanted to. But I think in this one, are you using the 10-week line on this one yet, Dr. K?
Let's see. It's well, it's got 1, 2, 3, 4, 5, 6, 7. Yep. This would be a 10-day. So in other words, if it breaks below yesterday's low, then that's the 10-day violation.
Right. Light in the box, LITB. Yeah, another thin stock. It's a $19 stock. It's a cheesy little thin stock. It had a viable gap up, flopped around. I don't mess with these stocks. So you want to ask me what I think about it? I don't touch them. They're not anything I would play. They're thin little cheap stocks, Chinese stocks. I'm not into them. And when they run up, everybody's happy. When they come in, everybody wants to know what you think. And there's really nothing to think because from the start, I'm not into them. Somebody asked GLD or GDX, what's better? Whoops. If you're going to have a sustained move in gold, I think it's going to be based on some factors aside from the stock market acting well. So my view is that mining stocks are stocks, and if the market comes off, they're subject to pressure from the stock market as well. So my view is if you think you're going to make money in precious metals, probably the best way to go is with the GLD and the SLV. Apple, you had a bottom fishing pocket pivot type move here, I thought, and you run up above the 200-day moving average. So at this point, you're extended on the bounce, and it's done pretty well. You had another pocket pivot here coming up to the 200-day, and it's still holding it. So I guess, if you like the stock, it's still holding up. But again, if the market gets weak, it's probably going to come out. Amazon, I don't like Amazon. I mean, it was acting well before. Now it sucks. kind of a little minor violation now, the 50-day moving average. Not really happening. So I'm not really a fan of Amazon right now. It should have held up a little bit better. It's coming all the way back to the breakout point, but to me, that could just tell you that it's just not as strong as it should have been. So anyways, what are sectors you will never play? Well, utilities, yeah, that's one sector. But oils have always been difficult. We don't really try to get into categorizing what we'll never play this or we'll never play that. I used to think I would never play defense stocks, and I did back in 2001. So
Yeah, and
anyway,
oil's in 1997,
yeah.
but it's highly unusual.
MELI, this one failed on the viable gap up, so there's really not much to think about there. That's a stop out. And that's pretty much it. It's pretty much at the end of the hour. So and my general view is I don't think I want to own any stocks right now. I don't really like what's going on. I know there are some stocks acting okay. If you own a stock that's acting okay, then you continue to hold on to it. I would say if I own thin little junky stuff, I would be very cautious here because if the market starts to get into real trouble, then you're going to get into real trouble, and you don't really want to go there. So but if you have thick stocks that are acting okay, then you might try and sit with them. I do think, though, that you're going to see, if the market's weak, you're going to see most things continue to sell lower. So it really gets down to preserving profits. Somebody comments, we'll finish off with this. With so much talk of money from bonds going into stocks, is it realistic that shell-shock bond owners will buy stocks at all-time highs? I don't think so. I don't buy into the argument necessarily that bond owners are going to suddenly buy stocks. Anyways, I think that's all we've got for now. I need to get back to taking it easy. So it's been nice spending the last hour with you guys. Thanks for showing up. And I think we will catch you next time.
Take care, everyone.